So governance broadly means the systems, processes, and the laws to ensure the optimum management and operation of the company. Now, typically in undergraduate law courses, such as in Australia, our focus is more on shareholder rights and directors' duties and how that creates monitoring and the laws that are required to ensure the effective operation of a company. But in Japan, at least in the scholarly context, an image has emerged, especially popularized by Professor Aoki, an economist, who referred more broadly to corporate governance in Japan as a series of interlocking institutions: the main bank system, keiretsu, lifelong employment, distaste for hostile takeovers, and lifelong employment, all working together to create an emphasis more on long-term productivity rather than the Anglo-American model of short-term profiteering or shareholder primacy theory. So before we discuss whether that's a myth or whether that's changing, first of all, let's talk about these different institutions, what they were like in the past and how they have changed. So first of all, the main bank. Can you tell us a little bit about what do we mean? What does it mean to have a main bank in the Japanese corporate setting, and what monitoring or corporate governance function was the main bank said to have served?
Well, and as a background, I have to explain that Japanese businesses, at least big companies, tend to deal with multiple banks. Mm-hmm. So a survey in late 1990s, I think, showed that one big company, it had the average of, say, a dozen of banks as its trading partners. Mm-hmm. So among these a dozen of banks, only one or at least two have controls over the settlement account. So other banks participate in the loans to the company, but they do not, at least do not handle or control the main part of the settlement of the company. So, and the main banks control this, so they can monitor the inflow and outflow of cash, and so they can monitor the financial situation and the solvency of the company. So that was the key.
Linked to the main banks is what's called keiretsu, or interlocked shareholdings, the idea that companies form sort of like an industrial group, and they hold not necessarily majority shares, but significant stakes in one another. And via that cross-shareholding, they can monitor one another and thereby allow for longer-term planning rather than short-term profiteering, because they're all invested in one another. Once again, is this a fair characterization of Japanese companies in the post-war period? And even if so, what's been happening recently with respect to these cross-shareholding arrangements?
In 1960s and 70s and until the end of 1980s, yes, it was like that. And although this was again known by the Japanese term keiretsu, that's different from the keiretsu that I mentioned earlier, that's the supply chain. So that's totally different. And it must also be added that the main banks were also among this a circle of cross-shareholding. And that has totally changed after 1990s. First, the burst of bubble and then the long-lasting economic downturn has urged many companies and also banks to throw away these shares standing in cross-shareholding. And if one of the parties to the cross-shareholding sell those shares, then the other party, of course, will also part with these shares. So now the cross-shareholding has dissolved to a greater extent. Mm. And what replaced this? Well, what replaced were the institutional shareholders, in particular non-Japanese and foreign institutional investors. Mm-hmm. And this has totally changed the equity market of Japan, and also a totally different a scene to the corporate governance and a discourses in Japan.
So traditionally it has been said that Japanese boards were large and they tended to have insider candidates, usually from the pool of loyal, lifelong employees. Now, before I get into what has been happening recently, because this is a big area of discussion, I think we need to start off with the definition for those, especially in Australia, also England and the United States. The kansayaku, or what's in English is translated as the statutory auditor. Now, this is common in Europe. It's also adopted as a monitoring system on the board in Japan. Can you tell us a little bit about what is a kansayaku and what function do they have in relation to the board of directors?
Well, and yes, and that's kind of a puzzle to many non-Japanese observers. And the difficult part is, over years, their role and their status have changed. But one thing that has not changed is that they do not have a vote at the board of directors. So unlike the supervisors under the German corporations in Germany, kansayaku in Japanese companies do not have the power to appoint or dismiss the executives, or they do not vote to change the management policy of the company. So what they do is really to monitor. And if there is something wrong, what means with something wrong is a big question. So is it limited to legality, or is it something that is, well, and statutorily it is legal but not appropriate in the corporation's position? That is a big source of discussion. But anyway, if there is something wrong, then the kansayaku's power is to report it to the shareholders assembly so that the shareholders can take some action. Or if it is a really illegal matters, then bring suit to the court so that the directors committing the illegal actions will be either enjoined or be ordered to compensate damages to the company.
So now we've got some clarity as to what a director is, which is more familiar, I would imagine, to our viewers, and what a kansayaku is, which is this imported concept from European corporate law with Japanese characteristics. Now let's look at the actual directors themselves, whether they are alone or two or three, or whether they constitute a board. Now, one of the major areas of legislative reform, even before the 2005 Companies Act, has been looking at ways of diversifying or getting Japanese companies to rethink the way that they organize themselves in terms of the board of management. So what are some of the ideas, some are so-called American or Sony style? What have been the development of ideas in terms of how a company should or may organize its directors?
First came the idea of distinguishing non-executive directors from executive directors. So traditionally, as elsewhere, by the way, and traditionally, Japanese directors were mostly executive directors. So they were kind of director and officer at the same time. But the idea of non-executive director, I think that came up even in the Anglo-American economies, only late 80s or early 90s. But this idea came to Japan, and first, yes, you rightly said Sony was one of the first companies to pick this up, and so started to divide executive officers and executive directors, serving as officers as well, and then non-executive directors. This was developed into a statutory and a arrangement in 2004, and by the amendments to the then corporate commercial code, and a new type of a corporate governance structure was introduced as an alternative or option to the traditional corporate governance structure with kansayaku and board of directors. And then most recently in 2016, and the third option has been added. So, and how do and again, this third option differs from the traditional structure, because the third option do not have kansayaku either. So, and the third alternative was introduced most recently, which has, again, only one board of directors, and then only one committee, which is mainly in charge of audit and monitoring of compliance, but partly and has some voices about the nomination and remuneration. So, and these two structures, besides the traditional one, which has one board of directors, and then kansayaku, now in bigger companies, kansayaku also has to organize its own board, so two boards in parallel, which is a very kind of a unique system to Japan. And so together with this, so there are three options.
How has the board changed? So before, the image was of large-sized boards, mostly of insiders. So firstly, have boards shrunk in terms of their numbers? Secondly, what's the balance between insiders versus outsiders, and not just outsiders, but also insiders versus independent directors? And thirdly, what is the pickup of all these different options? How many have gone for just the board? How many have gone for the one committee? How many have gone for the three committees? How many have gone for some type of voluntary compromise? So what's the pattern looking like today amongst boards in at least larger companies in Japan today?
Maybe it's better to answer your last question first. Okay. And so the one board, three committee system, so totally kind of copying the US system. And there are only 70 companies among the listed companies. And the most recent one board, one committee company. And I think the number of companies that have chosen this structure surpassed 1,000. Still, Tokyo Exchange has Tokyo Stock Exchange has 3,700 listed companies. So that means 2,005 or 600 have remained with the traditional one board and one kansayaku board structure. Board members were in those days 30 or 40 or even more. But now that's totally gone. Now I think average is more or less 10 people becoming members of the board. And the second big change is, as I already mentioned, most of the 40 or 50, 30 or 40 board members in 1980s were executive board directors. So they were engaged in the day-to-day business in some way or another. Now, among average 10 members of the board, and there are non-executive directors, and at least two independent and outside directors are required by the stock exchange rules. So it's almost obligatory. Stock exchange says that, and it is not obligatory, but you have to give the reasons that and why you do not choose this. So, and it's almost, after all, it's easier for companies to appoint two independent directors. And furthermore, the amendments to the corporate law made last year has introduced that listed companies must have, this is legally statutory mandatory, must have at least one outside director.
COVID-19, what impact has it had in terms of corporate governance? Have there been any issues that have arisen, or do you see any future issues arising in 2021 following the pandemic?
One very direct impact took place with regard to shareholders' general assembly. So Japanese companies, and most of them hold shareholders' assembly in late June. And late June was still just after 1 month of the end of the declaration of emergency and by the Japanese government. So emergency was declared in early April and ended in late May. So when it ended, there was only 1 month left before a general shareholders assembly. So this year, kind of without a solid statutory basis, and a government and also private lawyers took the view that the shareholders meeting could take place virtually without a getting together physically, and under the current statutory scheme. And it was a decision, at least under the emergency situation. But now, and people are starting to discuss, why not give this a permanent and a status? So why do we get together physically every year? Is it really necessary? If the important thing is communication with the investors plus voting on important issues, why can't these be done virtually through the network? And of course, in a more broader sense, and the risk management has been accepted as a big issue to corporate management. And it was not only COVID-19. So in 2019, for example, we had a few very big typhoons hitting the urban area, including Tokyo. So universities were closed on that day, and on the day before, I would say. And many shops also chose to close early. So, and it was again, it again gave the corporate management and a occasion, opportunity to think about the risk management. And still the memory of a East Japan earthquake in 2011 is quite vivid among many people, many Japanese people. So given all this, and with the COVID-19 pandemic in 2020, and now the corporate management has to really take this issue of risk management and contingency seriously, which will be a big corporate governance issue in the coming years.